this moment. That prompts us to move on to the next panel discussion, which is going to be on the creation of real estate-specific banks and fund houses. Can I request everyone to kindly take their seats, because this is going to be an enthralling discussion, and I would request everyone to kindly take their seats and enjoy it to the fullest. I would like to firstly call upon our moderator, Shri Ravi Reddy, Director, GPR Group, who is a renowned investor with a portfolio of his works across the world. Over the last 2 decades, he has played an active role in managing investments, mergers and acquisitions and strategies across many industries. Please put your hands together for Shri Ravi Reddy. Our first panelist for this panel discussion is Shri Suresh Marmareddy, who is the head India Real Estate Apollo Global Fund, and who is responsible for sourcing, underwriting, executing and managing real estate investment transactions in India. He brings over 23 years of experience in real estate, private equity and debt investing, portfolio strategy and research. Please put your hands together for Shri Suresh. Can we have you on stage, sir? Our next panelist has been introduced before. Please put your hands together for Mr. Zulfikar Gadiali, Executive Director, Business Management, Sheikh Hamdan bin Khalifa Al Nahyan. Sir, can we have you on stage, please, with a big round of applause? Our next panelist is Mr. Ashwini Sharma, Senior Director and Head North India Capital Market and Investment Services, Colliers, who is an investment banking professional with a diversified experience portfolio of over 17 years in the real estate industry in capital markets, project acquisition, NBFC lending, and advisory and valuation services. Please put your hands together for Mr. Ashwini Sharma. Our next panelist is Shri Vivek Agarwal, Principal Investment Officer, Swami Investment Fund, SBI Cap Ventures Limited, who has close to 17 years of experience in assurance, consulting and real estate investments across the Indian market. Can we have a big round of applause for Shri Vivek Agarwal? Our next panelist is Shri Ashwinder R. Singh, CEO Residential, Bhartiya Urban. Unfortunately, he was not able to make it, so we are going to move on to our next panelist, who is Shri Vikas Rajvanshi, SEBI Impaneled Auditor. Our next panelist, last but not the least, is Shri Yadav Ramashriya, Founder and Chief Executive Officer at Integro Asset Management. Can we please welcome him with a loud applause, Shri Yadav. Okay, I can request everybody to kindly take their seats. And before we begin, I think we need some energy in the room. So how about we try some... No, sir? Time for drinks now? All right. We have to listen to our guests. We are very hospitable hosts, so I'm going to leave you to it. But we'll do one last shout out. Okay, simple question. Simple question. Do you want to get the drinks on? Do you want the bar to open soon? Yes. Like our guest rightly said, I can only hear a yes from the panelists. Yes. Do you want dinner and bar to be open soon? Yes. Oh, I don't think we're going to make that happen very soon. It has to be louder. Yes. Do you want to start the party soon? Yes. Oh, louder. You want to start the party soon? Yes. All right then. Please go for it, gentlemen.
Hello all. Thank you very much, gentlemen, for being here. It was short notice, but thank you for taking the time and being here to, I think this will be a very interesting session, because this is something that a lot of our members are very interested in knowing, because it's absolutely very new for them. They have the experience of working with the banks, because a lot of our members are also like mid to small size developers. They're very used to banking products, but for them, the concept of fund houses, the concept of alternate capital is very new. So I think you throwing some light on this would be absolutely phenomenal for a lot of our members. And as we proceed, I will also ask some questions regarding what are the different forms of capital that our members can access within the Indian ecosystem. And it would be great if you can let them know about that, and also how they can aspire to be, fund managers per se in the future, they themselves. So let's start with, I will first start with Ashwini Sharma from Colliers. So I would like, Ashwini, for you to throw some light on the demand scenario in the different sectors, and also the capital scenario in the different sectors, even regions across India, in real estate, in the different sectors of real estate.
Yeah, thank you, Ravi, first of all, for having me here. Well, the demand post-COVID, what we have seen is we have witnessed an exponential growth, which means there are buyers for different kind of products. With respect to investments, if you foresee, like last year, we have roughly around $5 billion of investments into the country, primarily creating to the office segment, your residential, alternate assets. And the demand, the last year witnessed some of the record sales in terms of office absorption, in terms of residential sales. And we expect the same momentum this year going forward and in times to come. Having said that, what will fuel this demand? The steps taken by the government, largely they were more inclined towards the infrastructure side, where 10,000 crores per year was defined by the government to invest into that. And we have seen such developments like your Mumbai-Nagpur Expressway, your Delhi-Mumbai first phase opening up. So that creates a vacuum, or that creates an opportunity for all other asset classes to move into that geography and that domain. However, once you see like, say, post-budget, people expect some kind of incentives and all, but what the government did, they provided more growth opportunities. Of course, the repo rate did increase a bit, anticipating some kind of pressure on the home loan, but having said that, the disposable income increased by giving rebate on the income, by rebate on the income tax slabs. So all these things put together, they all fuel the demand. There are various pillars around that. So commercial, office, residential, we've seen how the growth has happened. Recently, a grade A developer within 2-3 days did somewhere around 1 billion of sales for a luxury segment. There's a huge scope of opportunity in terms of your affordable and as well as luxury. Of course, both are different tracks, both cater to different kind of funding, both cater to different kind of buyers and absorption. To answer your question, capital, as Colliers, we deal with all financial institutions, right from cheap capital to expensive capital. There is capital available for each and every asset class. The risk parameter has to be assessed, and accordingly, the solution has to be provided. But having said that, once a developer goes ahead and adopting an expensive cost of capital, then a product report in terms of how the performance has been should be vetted out to all other financial institutions so that when the timing is right, it can be replaced by a cheaper cost of capital. That's what my 2 cents would be on in terms of the capital, or in terms of course, there are dignitaries with respect to the all sort of capital we have.
Can you also throw some light on the capital absorption in different regions of the country? Where are you seeing more absorption? Where are you seeing lesser absorption? What kind of capital is being absorbed in different, like Delhi NCR region, what kind of capital is being absorbed versus the south?
Well, I can say more predominantly about NCR per se. This region has bounced back, not with respect to NCR per se, but tier 2 locations as well. So lenders or private or financial institutions who not used to consider NCR in the earlier stages, now they have started investing. into the products because they believe in the demand story, they believe in the growth, because there is abundance of raw material, what you say, land, available in NCR per se. Of course, West and Mumbai have been doing, West Mumbai and South, they have been doing significantly well, but they hold some of the largest office portfolios as well. So I would not be able to put a percentage to it, but yes, there is significant scope for investment, and Tier 2 locations, I think, should be considered for more investments because there is a lot of growth potential in those locations coming in.
So which regions in the country do you think can absorb higher cost of capital than a few other regions, according to you? Just a little bit more complicated, but I think...
Yes, it is complicated because every state has its own bylaws with respect to approvals. Certain states would allow you to absorb a particular level of FSI and then go for approvals. Certain states will allow you to invest on approvals at initial stage, creating a, I would not say a pressure, but on an aggressive scenario. So that's what my take would be. I feel, yes, North, West, South would be on a higher side, followed by East, because East India is also coming up in a really big fashion.
Ram, would you like to throw some light on this?
I think as far as the numbers on region-wise is concerned, he is the authority in that, and whatever he spoke, I completely agree to that.
Yeah. So, Ram, this question is for you. What is the necessity for new region-specific funds in real estate? You know, I mean, you are a fund manager, you're running a fund manager's fund successfully, and you're focused in Bombay, I suppose, right? Like, what is the advantage of having a region-specific fund?
Yeah, so, I mean, if you look at India, it has close to about 720 districts, and all 720 districts have their own administration, and then there are states on top of that, and then the urban ministry. Looking at that structure, it is very important to see that each geography will have a very different kind of regulation and a very different kind of, requirements, culture, buying patterns, behaviors, and then the pricing. So you cannot underwrite one geography with the same brush of, rules for the other. And that's why it is very important to, while, and our friends are here who have actually done a phenomenal work on that, they have kind of divided the entire thing in different regions, and they have been very, very successful on that. I think that's one area that most of the fund houses or financial companies will have to go, and rather than creating one single brush of rules, they'll have to create underwriting structures which are very, very differently suiting to different geographies, and that's exactly what we are doing. When we are focusing on, say, Maharashtra, we have got Mumbai and Pune as two core markets. When we are focusing on commercial, we are looking at Hyderabad differently and Bangalore differently because both have very different. So capital is one, the way to look at cash flow is one, but then these are very different, and that is what is very important when we are funding the working capital. So that's what we are trying to.
Vivek, would you like to throw some light on your experience of working in different regions of the country as a Swami Fund?
Sure. So as Irfan highlighted earlier, we've funded projects across 40 cities. So what comes differently in different cities is local laws, cost of construction, availability of labor, availability of materials, and how the timelines are different across various projects in various regions because the approval mechanism of every state is different. We are dealing in NCR where 3 states have different laws, rules, and regulations where, some of the pre-project approvals such as licensing are different. In Noida, the license is given by the Noida Authority. In Gurgaon, the license is given by DTCP. So all that, creates much more difficulty in state of residential projects. So obviously, Swami has come a long way in analyzing those and we go deep down while during the due diligence, we go deep down understanding what can be the challenges of delivering the ultimate project to the consumer. So that local knowledge of the laws prevailing in that state is very important. We've done projects in Vizag, we've done project in Panipat, Amritsar. So that's the bandwidth, or that's the length and breadth that Swami operates by going deep into the understanding of what is necessary for each and every project in that particular city, what is the approval timeline, what has been the demand, what has been the supply in that region, and then we try to underwrite that project.
So even though you're supported by the government, you're one of the very successful funds in India, having deployed more than 10,000 crores so far and having managed so many projects and delivering so many homes to people. When you started in 2020, it was brand new, and I remember meeting you guys at that time, and it was very fresh, but now you're very seasoned professionals, you've learned a lot. And what are some of the risk mitigation techniques that you have employed, and some of the portfolio management learnings that you had in these last 3-4 years that some of the up-and-coming fund managers can learn from you?
So, there are more and more learnings as we are coming up the curve, but obviously there are 4 or 5 key factors that why Swami has been so successful across various projects. One of the key factors is that we focus only on construction. So residential project is something that doesn't need, for us we believe that doesn't need marketing or channel partners that people do, that these are the projects that or these are the marketing strategies that people employ. If you are focusing on construction and you're building on slab by slab, let's say for a 30-day cycle or a 20-day cycle, your project will definitely see sales if your project is getting constructed. Second, diversion of money from the project outside. So that is one thing that we've kept a very, very strict vigil. We have a project management company on the ground. We have project monitoring consultant on the ground, which gives us daily project reports on where the money is going to get spent. And third, the burden of the interest on the project. So we at Swami Fund, we don't charge any interest while the construction is happening. We only charge redemption once the project has been completed and OC has been given to the project. So these 3 critical factors are basically the learnings that we've had. And also the control of escrow is very important. We at Swami have total control on the escrow. We give direct payment to the vendors. We in fact go beyond and become a virtual CFO of the project by giving salaries of the developer employees directly in their account, so that the employees are motivated enough to deliver the project on time and commit to the cost as well, which has been budgeted.
Excellent, thank you. So the next question is for Zulfikar. Zulfikar, if you can throw some light on the investment sentiment, especially towards Indian real estate, in a very candid way. I mean, if you can throw what are the positives, what are the negatives, what are the takeaways some of the developers can take back, especially when large funds like yours or like sovereign wealth funds, when they come into India, what is the impression they have about Indian real estate?
Sure. Well, first of all, thank you for inviting me to this panel, and I appreciate your question. I think it's very pertinent to where I'm coming from. We see India as a continent. We don't see it as a country. So there are 4 different regions geographically. The most favorite one for institution, and all of you will agree in this room, is the southern part of India. And then comes the west, the Mumbai market, Mumbai metropolitan as we call it. And then least favorite will always be the north. Unfortunately so, because most of our large investors from Abu Dhabi and Dubai have lost their money. So having said that, I'm not being pessimistic here. I'm just trying to highlight the fact that the developer also needs to think long-term when they attract an investment. It's very easy to cheat an investor, especially when he's a foreign investor. But if you made a multiple for that investor, he's going to bring 10 investors with them. And that's where I think the Bangalore developers have made a big gain because of their corporatization at the right time. They have institutionalized themselves in the right time. They have done all the check boxes that an investor looks at. Now, there are two things that we look at in India. One is there are some high-risk projects. They're very huge on returns, like some luxury tower in Mumbai, for example. It's a high risk reward kind of a project for us. But do we invest in that? Yes, we do. And then at the same time, there is a very large project somewhere in Bangalore. It's a township that also is an exciting project for us. How do I put it? It's a pure equity deal we prefer. But most of the times when developer come to us, they ask for a rate of interest batao. Equity partner, we are not sure. Wo headache hota hai equity partner. So unfortunately, that's what we hear from developers. Equity partner is the least favorite of mine because then he comes and checks my books and interferes in my way of business. I mean, trust me, the investor is not interested in that. The investor is more interested as you have your checks and balances at Swami. We also have certain expectation in terms of certain MIS or certain reporting that we need. But overall, if you ask me about the sentiment, it's very favorable towards India. Look at the war zone in the Europe today. So it's definitely not the zone that we want to go preferably. But there are some select markets in UK, for example, or the upcoming Scandinavian real estate, which is attracting a lot of young talents. So the demand for office space has gone up. Similarly, we see the similar trend in India. The demand for office space has suddenly gone up. So yes, there is an interest on income producing asset, like I said in my speech when I spoke in the morning, in the afternoon, that the Arabs, and especially the Emirati investors, they're more keen to see income producing asset. They're more keen on touch and feel. So if you show them an asset, which is, even if it is $1 billion deal or a $2 billion deal, they don't care. They have the check writing ability. They will write a check for you. Now, this is about the big developers. Now, coming to the smaller and medium-sized developers, there is definitely an appetite. But like I said, our biggest challenge being the ticket sizes, because we don't like to look at, on an average, 500 million to $1 billion deal. That's the kind of ticket size we like to work on. But then in India, even looking for $100 million check size is like a challenge, and that's always the big guys. That's when I met with Mr. Satish from the finance committee of NAREDCO. I think 2-3 months back we met with each other, and he asked me, what can we do? And that's when I suggested him that I can set up a fund in Abu Dhabi for you, where I don't like to do fund of funds, but this will be a fund which will support direct projects if they are sizable enough, and at the same time co-invest with an Indian fund. So the Indian fund, we would expect to put at least 10% of the money, and remaining 90% we'd like to bring in, no problem. But at least we get a hands on the grounds, who can actually manage the fund. So, I mean, that's one of the ways I can think of bringing money for smaller projects in India.
I also overheard you saying that you like some of the projects to have their, not the projects or the companies, to have their holdco back in Abu Dhabi. It gives you the comfort for you to invest into those projects. I mean, why would that be? I mean, there is a very solid legal structure in India, so, but why would you want the holdco to be structured in your jurisdiction? Just some light on that.
Just like I said, Arab by nature, they like very touch and feel. Go back to 3,000 years back, what they were doing. They were going to the Chinese, they were picking up the silk, they were selling the silk to the Indians, taking the spices, and selling the spices to the Europeans. So they have always been traders. If you show them something, it's there somewhere very far, they just don't relate with you. And imagine, I mean, a guy sitting in Abu Dhabi, he sees people from 200 countries coming to him, all look fancy, all dressed up very nicely, all bring lovely brochures with them. Whom do you trust? It's like I booked a ticket on Make My Trip, and I booked a ticket with a travel agent. I'm at the airport. That lady at the agent, she says, this ticket has a problem. So there are two situations for me. One is call Make My Trip. For English, press 1, Marathi sati don daba. You are stuck with that forever. But if I had booked a ticket with a travel agent, I just call, hey, yaar, solve kar problem. And he knows I have to solve his problem, otherwise he'll come to my shop and bash me up. That's always a fear.
So
that's why the Arabs, the mentality in the Middle East is that, come set up the shop here with us, show us that you're not just here to take money from us, but you're here to also help our economy. Now the pressure always on us has been, and by the way, UAE and Middle East biggest export is not its oil, it's money. So when we export the money out, and then the Western reports, which is, I call them Western bitch media, they write that GDP of UAE is not growing, GDP of Abu Dhabi is not to the extent that it should be. I'm like, we are helping you. We are developing your countries with our money, and you have the audacity to write bad about us. But then we cannot fight with them all the time. So we decided, all these holdcos should be established in Abu Dhabi. So we're bringing in revenues in terms of our ancillary services, advisory services. We're increasing business for our free zones. We are increasing business for our tax efficient structures like Abu Dhabi Global Markets. We want people to come and set up business with us in Abu Dhabi. And if you want, and if you have the ability, come and start project with us in Abu Dhabi too. We will put the money with you, no problem. Money is not an issue for us. The issue is how do we hold you accountable? How do we create that touch and feel bond? You love me, marry me. Simple.
Absolutely. Excellent. I think great feedback for our developers to take back home.
Irfan bhai, you love that answer, I guess.
So the next question is for Suresh. You are managing director of a very, very large fund, global fund. Your fund manages about 350 billion across the globe, and you still have 0.3% allocated to India in a year. That's peanuts. I think that's what you spend, on your yearly compensation for your staff probably. So why is that? Why is this stepmotherly treatment when it comes to India?
I think the allocations are not rigid and they're not fixed, right? So it changes by the market conditions. So I think the better way to look at it is like 3-4 years ago, our presence was a lot less. So I think, in the last 3 years, we've invested more than most of our peers. So I think the capital will keep coming to India if the opportunities are there, and I think there are a lot of funds now, foreign funds, who are putting money. So just for the benefit of the group, the foreign funds are largely operate in 3 buckets, right? So one, they're seeking rental income, those are what we call core assets. I think you spoke about that a little bit. Then you have those funds and investors capital which is seeking out and developing assets. So you'll see a lot of the Singaporeans who are doing that. They are building a lot of office buildings, retail, and then now more increasingly a lot of logistics. And then you have solution capital, which basically can go into any sector, and that could be debt, that could be equity, or it could be mezzanine, depending on what the need is at any given hour. So I think there is a lot of capital which is available, and I think it's just that there is a pyramid, right? So I think, as you kind of get closer to the foreign capital, the ticket sizes are larger. Usually it's 50 million. I think he was talking about much higher ticket sizes. I think that the ticket size can be met, and generally, it's not just in India, but even if you go to the US, when the Japanese came to the US back in the 90s, they stuck to just 3 cities, New York, Chicago, and LA. And I think, the same thing is happening here. You see foreign investors are largely focused on 6 cities, the 3 southern cities, and NCR, Mumbai, and Pune.
So another question for you, Suresh. From the limited information I know, funds like Apollo, back in the US, they look for very, I would say, reasonable returns, like 7 to 9%, 8 to 9%, something like that. But when you come to India, your expectation on return goes up significantly, where you are expecting a 22 to 26% return, I'm thinking, So can you throw some light why this is the case?
I think it's a tricky discussion, right? So if you're looking at equity return, I think a developer also looks for that kind of return. So it's no different. And I think going back to what my esteemed panelist was saying, that you wouldn't expect to make the same amount of return if you're putting in equity. I think in debt, I don't think the returns are that high. Also, you have to note that eventually someone sitting either in the US or in the Middle East is not going to cut slack because you invest in India. Ultimately, he's looking at a dollar return. And after the withholding taxes and the leakage in hedging, which is about 4.5%, you will go to 8-9% only on a lot of the debt transactions, unless you're doing high yield debt, which doesn't really work in India.
The pricing is high. I'll tell you something. See, the pricing is high. I mean, a lot of people come to me and they're like, invest with us, we're going to give great returns. And he goes like, sir, our project is going to give you 40% return. I said, no, you're not being honest to me. No, sir, I'm sure, 40 to 50%. No, 100% return है boss. He said, हाँ sir, तो फिर invest करिए. मतलब problem is to लिख के दे मेरे को that you'll complete the project in 4 years. You know, the problem today, regulatory issues. RERA is still settling down. Half of the builders, half of the market doesn't even know what RERA is. SDG components are becoming difficult. ESG investing is getting tougher. You know, so the challenge is not the return. The challenge is, will you complete the project? So that's what, risk reward system. If I have to earn 8-9% return, I'm happy sitting in Abu Dhabi and making that money. Why would I come all the way to emerging market scenario like India and take a risk? So that's where that concern comes. And like I said, in India, challenge is not on return. But if you complete that project in that number of years, which we know for sure the developer will not be able to, because not his fault. And trust me, I'm a developer's family. I don't blame the developers at all. In India, developer means chore, is a criminal. So from that level, the system, the entire country looks at you that way. From that to survive and come up is a big challenge. You ask any guy who landed in Bombay after 10 years, after 15 years, he says, बहुत कुछ बदल के क्या बदला? Road वही है, गली वही है, buildings बदला है boss. And that is because the private builder took that initiative. But still he's a thief. With that mindset, people start thinking further to real estate. And that's why the foreign guy, of course, sitting there, he also gets to know about it. So, of course, their fear, the pressure, and then he sees, okay, only 5-10% return. I'm not worth taking the risk. Give me 40-50% or more than that. I'm interested to come and take a chance. It's like roulette, you play blind.
That's where I think NAREDCO can help you in sourcing those kind of projects where you feel comfortable. Yeah, absolutely. And I think that's where our organization can be of great help for funds like you. It's a two-way street. Yeah. So I think. So my next question is for you, Ram. What are the different financing instruments that fall under SEBI for real estate, the fund structures?
I think there had been a lot of discussion about instruments just in the previous, panel discussion. But more than that, I just wanted to bring 2-3 points because we are talking about why this rate of, say, 8 and 9, why it becomes 20%. I think it is to do with the way we perceive the risk and the way we see the risk being managed. So first I would answer that. The second is, I think what may change in India, because we are all here to really try and see what is really there in store for us. And I see that same question in a very different perspective. And there are 3 things that I wanted to talk about before I move to that. The first is that we are currently somewhere at about $2,000 per capita income. This is exactly where US was in 1985. This is exactly where China was in year 2006. China took 6 years. US took about 9 years. We are expected to take about 7 to 8 years to reach to $6,000 per capita income, which is 3 times. So at $3 trillion and 2,000 per capita income, the young population, I think the real estate story has not even started. That's the first point that I wanted to make. And the reason I'm making that point is because of 2 things. One is, where will the demand come from? That is one question to answer. The second is, where will the money come from? India as a nation was an equity-starved nation. We completely depended on the foreign capital. And if I have to tell you just the AIF, one of the instrument, alternative investment funds, when I started, and we are a very small startup 3 years back, the quarterly mop-up or quarterly commitments in AIF were less than 20,000 crores. That size has today reached to about 8 lakh crore, and we are raising close to about 70 to 75,000 crore rupees domestically from Indian markets. And I think that is where a lot of question lies, that how will this whole thing move So AIF in India has grown by a CAGR of about 60%. And that's a hoping number. We are still somewhere between 50 lakh to 60 lakh crore in mutual fund. Equity markets, of course, will take their own course, but in AIFs, there is one big move which is happening. The second point I wanted to bring was that we have to somewhere also discuss and talk about where is the elephant in the room. And I've always maintained that the 2015-16, when RERA came, it was the SEBI moment for real estate. And today, as we talk about, I think the elephant in the room, beyond what organizations like NAREDCO are doing, which is equivalent to what happened in the IT industry. Till 99, 2000, it was all that, computers and people. And after that, suddenly there was a boom in services and we were on the leadership. I think the same will happen through a lot of efforts from NAREDCO and all. And also with the funds like Swami and our friend is here, I think what they've done for this country is they've shown that the financial services companies cannot treat real estate as one of 100 activities. It is a very, very specialized field. It needs a very special attention, a different way of building the team and not being monitored from the top saying, okay, this is only a 2%, 3% of our overall portfolio, so we should just, depute somebody to take care of it. And I think this is what has changed in this country with Swami. And congratulations to Irfan and everybody in the team that they've really shown it and the size. The third thing is the elephant in the room that I was talking of, is the digitization. I think we are still not giving the due credit to what digitization has already done. We are a very small prop tech, and as of now, or a startup, as of now in last 3 years, we have invested 100 crore only in technology, even before we started putting in the money. I think my request to most of the developer friends here is, move beyond Excel. 2006, you could do DCF and say that this is the value. We are still 0.8% of the overall capitalized market of 3 trillion plus. I think we can go up to 8%. So there is a lot of money which will be available from the capital markets, the public markets, and then the alternatives. And lastly, then comes the banks, and banks which are specialized. And Swami is one of them. I am sure there will be many. Integro we are building. We are at a very early stage. And I hope there are more who will follow the footsteps of Swami in Integro.
See, as a domestic fund manager, what are your challenges that you are facing, especially because you have the bandwidth to support mid-sized projects as well, or small-sized projects, or actually get down deep, right? So what are the challenges that you are facing with your clients, but also even SEBI, for instance, like overall? Can you throw some light on that?
So I think the biggest challenge that we are facing is the lack of investment in digitization from the developer side, which eventually comes and hits back. That if you look at last 20 contracts signed by any developer, and I'm not making any exception, any developer, and then you try and see that in spirit and intent, how many of those contracts have been actually followed to the T. If you cross 10%, I think then this country will change. So developers have to start respecting the contracts. And this is the only challenge that we actually face. And if they can solve it either through, investing in digitization or in the spirit or building the team as, Julfi, our friend, was mentioning in his plenary discussion that, don't call the CA as a CFO. Go and invest in, getting a CFO. At least he can start putting some projections and start really following it. I mean, I see developers, and it is unfortunate, it should change, that you give a projection, and once the money is disbursed, you just forget about it, right? It's part of your contract. You can't forget the cash flow. It's the core of, the entire, this is our real challenge that we face on a day-to-day basis.
I have one question for Suresh. I know he's got a lot of money in the bank. So, so how does smaller projects or even mid-sized projects in India aspire to get access to some of your capital? What is and how can NAREDCO help in that process? Because I know you guys are funding large scale, you guys meet in classy boardrooms, do your deals and done. But like, how does a regular mid-sized company get access to capital from you guys?
See, right now we don't have that capital. I think because we have various limitations because of fund size and all that. And also, I think it's easier for people to say you have to invest in a smaller company, but the moment I say we need the big four as the auditors, that becomes a non-starter, right? It's good to aspire for capital, but as you get a lot of this capital, it comes with its own sets of rights and obligations. I think that will take a while, and I think, you know, what we've seen I've been in India for like since 2005, and I've seen a lot of the small guys start with domestic capital with banks or local fund houses, and then they scale up as they improve the process. And as Ram is saying, that you need to put a CFO in, right? Because when you access foreign capital, like the MIS and everything needs to be there on the 10th of the month, right? With all kind of audit obligations. So I think if some of them are ready for those kind of stuff, I think the capital will seek them out, right? But otherwise, I think it's a step. It's like, I think a kid trying to say, I want to go work for a McKinsey or whatever, right? It takes, like, you have to go through the process. You have to go through the college, you have to go through, you know, your training, and then eventually you'll get there, so.
So that's where NAREDCO is also, what we have done is we have partnered with EY, we are partnering with different consultants, the big fours and everything, putting a process in place for developers to access that, and then probably, you know, get some hygiene within their house, you know, and once they have it, I think probably they will be ready for presentation at that time. But thanks a lot. It was very insightful information from all of you. So, yeah,
I would just like to add something to it. The punchline for funds says right financing for the right projects. Over the last 2 or 3 years, I'm sure everyone in this room will agree that the developers have shortlisted the right projects at the right location. They now know who the buyers are, what do they want, what are the specs, what is their ticket size, and that era we have been witnessing. I think going forward, if there's a message to the developers that if the right location and the right project and specs is being provided and the right financing is right there at the front, available from all segments, I guess.
The message that developers can take from this session is, it's not the capital, but it's the hygiene, it's the processes, it's the execution, it's all the other parameters that you don't focus on that are more important than the actual capital. So what the esteemed gentlemen on stage are saying is, we are right here with the money, but get your house in order, be ready for us to actually bring our capital into your house. So that's a great, very positive message for all our developers, because I think they've been a little bit confused and looking at the wrong places, but I think from this session they probably have a better understanding of what to get in order before they seek out for financing. Thanks a lot, gentlemen. It was very informative and very useful to all our members. Excellent. Thanks for giving your time. Thank you.